Alright, for this video tutorial, I want to cover a sample form 1040NR for the 2023 tax year. Now, in this video, we have a non-resident taxpayer here that owns a disregarded LLC in the U.S. and is engaged in U.S. trade or business. So the 1040NR is going to include a Schedule C, net profit or loss from this business in the U.S., and in addition to this 1040NR filing, the non-resident has to also file the 5472 with the pro forma 1120, right? Because foreign-owned U.S. disregarded entities have to file the 5472 with a pro forma 1120, and that is a separate filing from the 1040NR. So this video is going to focus on the 1040NR. The 5472 video is separate, and I'll put a link to that below in the description. So the 1040NR filing, we've got the full return here. I've also got the sample financial statements for the non-resident LLC, which we'll go through in more detail. And then I've got one slide here covering some background on 1040NR filings, and then the details on the fact pattern that we're going to be looking at. So if we start with the slide here, just some general background on 1040NR filing requirements. These are generally required by non-resident individuals, or in some cases trusts or estates, and they're required if the person is engaged in a U.S. trade or business, or that non-resident has U.S. source income that's not connected with a U.S. trade or business, which is also commonly referred to as FDAP income. So U.S. source interest, dividends, rent, royalties, things like that. And so that would be required if there wasn't the sufficient amount of withholding tax on the income. So now, U.S. TOBs, unfortunately not specifically defined really under the tax code, so we have to look at IRS guidance, Treasury guidance, court cases to determine what constitutes a U.S. TOB. Now, court cases generally provide that the activities of the non-resident, either directly or through their agents, has to be regular, continuous, substantial, in order to be engaged in that trade or business in the U.S. And so what we're going to find in our fact pattern is that Adam is in fact engaged in a U.S. TOB because of those activities. Now, really important point here on gross ECI. So if you're engaged in U.S. trade or business and you have gross income that's effectively connected with that business, you have to file the return. What people often make the mistake of thinking is that, well, if my business operates at a net loss, I won't owe any tax and so I don't have to file. Not true, right? You've got to file the return if you have gross ECI. And you also have to file the return if you want to be able to claim any business deductions, right? So deductions and credits can only be claimed if you file the return. They're not kind of implied. Okay, so let's look at the fact pattern here. We've got Adam is a citizen and resident of Bermuda, and he wants to open a vending machine business in Florida. So he opens the Florida LLC as the sole owner. He pays the state filing fee and the registered agent fee personally. And so the LLC also does not make an election to be taxed as a C Corp. Very important, right? So because it's not a C Corp, the LLC remains a single-member disregarded entity for U.S. federal tax purposes, hence why we need the 1040NR filing and why we need the 5472 for foreign-owned USDE. Now, Adam opens a U.S. bank account for the LLC, and he transfers in $8,000. The LLC buys a vending machine for $2,500, and Adam also arranges to purchase some inventory to stock the machine. He finds a local contractor that's going to restock the machine on a weekly basis, so not a full-time employee, but just a contractor that's going to help him out once a week. And Adam also pays his brother, Bob, $450 for bookkeeping services during the year. Bob is also a Bermuda citizen and resident. Now, Adam is advised that the physical presence of that machine is going to create this fixed business location within the U.S., right? And so, given the activities in the U.S., Adam is engaged in a U.S. trade or business. He has gross income effectively connected with that business, so he's got to file the 1040NR and pay some taxes. Now, Adam has to file the 1040NR and separately file that 5472. Okay, very important. Again, I've got a separate video on that. Go check that out after this one. Now, Adam already has an ITIN, so that's an individual taxpayer identification number, which is required to file the 1040 NR. You do not need an ITIN to just file the 5472, all right? But you do need it if you're filing a 1040 NR. So Adam's 1040 NR, when we get a closer look at it, we'll see we need the Schedule C, profit or loss from business. We'll need the 4562 for the depreciation expense on the vending machine. 8995 is that QBI deduction. Schedule OI is other information on the non-resident taxpayer. And so we'll look at all of these forms. So let's go through the financial statements briefly here. So we've got the gross sales amount. So these are the items that are being stocked in the vending machine and sold. We've got the cost of goods sold, so the inventory costs on the gross sales there, and then various expenses. So the filing fees, bank fees, bookkeeping fees, the depreciation expense that's going to be recorded for tax purposes. We've just booked the same to match for bookkeeping purposes. And on the asset side, we've got the some U.S. bank accounts, so a B of A account, a transferwise U.S. account, the ending inventory balance, as of the close of the year. The fixed assets section, we've got the cost of the vending machine and then the amount of depreciation that was claimed for the period. And then in the liability section here, we've got AP, 165 outstanding. Capital contributions, so 8174 was put into the company. That's the $8,000 in cash that was transferred in, and the filing fees and the registration fees that Adam personally paid for. And then distributions, right? So Adam drew out $1,000 during the period. Okay? All right, let's have a look at the return now. So we've got the 1040 NR, we've got first name, last name, and the ITIN, and then the home address, mailing address in the foreign country. So Adam is living in Hamilton City, Bermuda. Digital asset question, answered no, right? So he didn't sell or trade any crypto, and he is a single filing taxpayer for U.S. federal tax purposes. Now, we can see here, page 1, ECI, we've only got one line item, and it's going to be the net amount of loss flowing through from that Schedule C. So if we start with the Schedule OI, let me jump down to Schedule OI. Other information, so 1040 NRs, all filers should complete this. We have the name, ITIN, and then the country of citizenship and residency. So both are Bermuda for Adam. Answer the rest of these questions, most just yes or no, right? So as they apply to you, so no, he was never a green card holder of the U.S., never a U.S. citizen, nor was he other type of lawful permanent resident in the U.S. Your immigration status, per the instructions, if you don't have any U.S. immigration status as of the last day of the year, you can enter this language, right? So not present in the U.S., no U.S. immigration status, that's fine. He's never changed the visa type. In question G, enter the dates you entered and left the U.S. So Adam did visit the U.S. in August for a few days, so he's entered that information there, and the number of days, full days, partial days in the U.S. was 5. Did not file any tax returns for last year. This is not a filing for a trust, and he did not receive compensation of $250,000 or more during the year. And so all these other questions can be left blank, right? This is important here for not for this fact pattern, but question M, this 871D election. So if you are invested in a U.S. real property interest and receive rents, the rent is generally FDAP income, but you can make this election to treat it as ECI. In Adam's case here, he's not engaged in this type of business, right? So this election is irrelevant to him, but just something to keep in mind if you're filing this and you have real property in the U.S. All right, so on to Schedule C, profit or loss from business. We've got Adam's name up here, the principal business activity, vending machines, and then the name of the LLC. So Adam Nonresident LLC, mailing address in the U.S., and then the EIN for the business. Now, question G, Adam did materially participate in the business, right? He's not physically on the ground, but he is running things remotely from Bermuda. He did start the business in 2023, so we've checked that box there. And yes, he did file 1099s because he did pay contractors $600 or more during the period, so he filed the 1099 NEC. Now, in the income section, we report the numbers as we see them on our financial statements. Now, if you have to make any book tax adjustments, you can do those. But in our case, we didn't have any unique adjustments, so our financial statements match what we have on Schedule C. So we've got the gross receipts or sales, the amount of cost of goods sold. And if you have cost of goods sold from inventory, you should complete the cost of goods sold and inventory reconciliation in Part 3. So Part 3, our inventory at the start of the year is 0. We purchased $5,186 of product. We sold $4,481, and so our ending inventory balance is $705, right? All of this matches our financial statements. And then we have the other various expenses. So the rents, taxes and licenses, contract labor. The depreciation expense, $2,100, that includes two components, right? So the bonus depreciation and the straight line depreciation. So if I jump down to the 4562 here, we'll go over the depreciation. So we need Part 2 and Part 3 completed. The special depreciation allowance, this is the bonus depreciation. So for 2023, bonus depreciation was reduced from 100% to 80%. So if we have a look at the depreciation schedule here, we can see we purchased the vending machine, placed into service on July 1st, and we paid $2,500 for it. The bonus depreciation for the current period is $2,000, so it's 80% of the $2,500. In 2022 and prior years, you got 100% bonus depreciation. Now that's changing. It's slowly coming down over the next few years. So in 2023, we've got 80%. The remaining depreciable basis is the difference there. That's $500, and that's depreciated over a 5-year lifespan under the maker's 200 dB method. All right, so the total depreciation for the year is the $2,000 and the $100 current depreciation component. So that's what we have up here in Parts 2 and Parts 3. We've got the bonus depreciation at $2,000, the remaining basis of $500 over a 5-year recovery period. All right. Okay, so that's the bonus depreciation reported on Schedule C. So our net profit here, $180, net loss of $180. That's the amount that flows through to page 1 of the 1040NR. And because it's a negative amount, we're not going to be paying any taxes, right? We don't have any positive taxable profits. Now, what's also important to remember is the QBI deduction. So if you have a U.S. trade or business and ECI, that is eligible for the QBI deduction, even though you're a non-resident. In this case, because the amount of qualified business income is at a loss, it doesn't provide us any utility in the current period. We just carry it forward. So on line 16 here, we've got the total qualified business loss carry forward of $180. All right, now the other important thing to remember is when we have a net loss like this and our AGI is negative and taxable income is negative, we have a NOL carryover. So the net operating loss carryover, if we jump down to the carryover section, so our NOL carryover for the year, $180. So this can be rolled forward to next year. And if we have profits in the next period, we can use these losses to offset those profits, right, within certain limitations. And then the last but not least, the election section. So we are making the tangible property regs, the de minimis safe harbor election under 263A-1F. This is that capitalization policy. So when you look at your profit and loss or your financial statements, if you have fixed asset purchases that are otherwise, under that threshold, you can elect to just expense them rather than capitalize them in our case. So anything in here that could arguably be capitalized, we're just electing to have it deducted. Okay, so I think that covers everything. I hope that was helpful. If you have any questions, please feel free to leave a comment below. And as always, I look forward to seeing you again on the next video. Thank you.